Welcome to Facts Pro, where it's all about facts, financial, accounting, and tax strategies. As year end approaches, and we're trying to figure out what can we do before year ends to reduce our tax bill. One of the things that a lot of people do is charitable donations. Is like to donate to charities in order to get that deduction if they itemize deduction. So today I want to talk about this, but in a smarter way, not just to donate to any charity, but also to multiply this donation. And instead of taking a deduction of $1 for every dollar that we donate, we take a deduction of like $4 or $5 for every dollar we donate. What is this strategy and what are we talking about? This is our topic for the day. So let me share my screen and we go from there. And as you know, I always start with a joke. And the joke today is like, why the IRS is always tired? Because collecting money for the government is taxing. All right, so I'm talking about the fee simple charitable land donation. What happens with this strategy, that this is a tax strategy that allow you to donate a land outright to a qualified charity under Section IRC 178. It creates significant charitable deduction. As I said, it could be like 5.5 times your invested amount or your donation amount. So you give a $1, you take a deduction of 4 times 4.5, 5.5 in some cases. It's a deal on deal basis. So you gotta check what is the deal that you're investing in, and you multiply this by your tax rate, that would be your tax saving. So it blends tax efficiency with investment opportunity. And we're going to see how that works. So what is it exactly? Again, the donor, you transfer the land fully to a 501c3 non-for-profit. This is the section of non-for-profits that are registered as non-for-profits with the IRS. They have to be registered. They have to be recognized as Section 501c3. This donation would qualify as a charitable contribution under Section IRC 170A, and you get the deduction based on the fair market value supported by qualified appraisal. So that's why you give a $1, but when you get a deduction, you get it based on the fair market value, which exceeds whatever you put in. And sometimes that's 4 or 5 times the donation. Same thing as you're donating like appreciated stock or any property that appreciated in value. You take the deduction of the fair market value, but you have to have it supported by qualified appraisal if it exceeds $5,000. So in this case, we're talking about more than $5,000. We're talking about hundreds of thousands of dollars. So, the key benefits here that you can deduct up to 30% of your AGI for capital gain property. And as we said, that's why like when we work together, we can work the numbers and you don't have to donate or you don't have to give in this investment more than what you really need. So you have to check your limits and depends on your AGI. You don't want to give it more. It's not the end of the world, but if you want to take the benefit of it for 2025 and you don't want to run into cash flow problem, then you may not have to give in more than a certain amount. So you have to work with the tax advisor in order to give you what is that sweet spot, what is the right number for you to give in to give you the maximum benefit. Any unused deduction, you can carry it forward for 5 years, but again, depends on your goals, depends on what you're looking for, your cash flow issues. You may not need to do or to go this route. As we said, there is a potential 5.5 times return on invested capital. Depends on what the deal is. Sometimes this number is 4.5, 5 times, depends. It gives you the option to participate in long-term development opportunities. So usually the way it works, you don't do this on your own. You go with the partnership, an LLC that they give you the right, or all the investors, the right to develop the land into like more, to do it more mining or something else, just to develop it, or to donate it. And it goes for a vote, and based on the majority of the votes, this is what happens. So if there is an opportunity for, as a long-term development opportunity, as an investment, you check return on investment, or you get the tax maximization of the tax deduction, which usually with these deals, most people do it for the tax saving, not for the return on investment, or not for the development piece of it. All right, so the tax saving mechanics, you invest the capital to acquire land interest, as I said, through like an LLC or a partnership. The land gets donated outright to qualified charity. The appraisal determines the fair market value. You get the deduction of the fair market value applied against your AGI up to 30%, and any unused portion you can carry it forward for 5 years. Most of the cases, there are minimum amounts that you can put in, sometimes 50K, sometimes 25K. 25K multiplies by 5. This is what you get as a deduction, your item on your Schedule A. So it's not like you're going to another charity and you give $1 and you take $1. You're giving $25,000 and you get a deduction of $25,000. This is an opportunity for you to maximize the deduction, and you take 5 times the original amount you put in. But when you do that, you're not looking for this as an investment opportunity. You're really looking for it as a tax opportunity. And really, the savings that you get from such investment it is really your return on investment. Is really your money back, in addition to even more money that you can invest in whatever you want, or you can donate it to whatever charity you like. So this allows you to do the other thing that you would like to do on a normal basis, if that makes sense. All right, so of course, there are certain rules and regulations that they have to follow. This LLC, they have to make the donation as irrevocable. So they cannot go back and say, no, we're not donating it. I'm sorry, I have to go back. Oh, sorry. Let's go back. Okay. So the donation must be irrevocable. The land must be contributed to a qualified 501c3. The appraisal must follow certain rules and must follow certain regulations with the IRS, and it must secure contemporaneous written acknowledgement. So it has to have certain regulations, have to have certain documentation, written acknowledgements, and the appraisal have to follow certain rules. All right. The compliance consideration. Again, you need to avoid the structures resembling listed transactions. So it shouldn't be like a conservation easement. It doesn't have to be resembling this, because if it does, then it kind of like void the transaction. Another thing, that the donor may not retain control. So once you donate it, you cannot retain control or rights over the land. And your development rights as a donor or as an investor must be properly separated and documented. So all these things you need to consider when selecting the partnership or the LLC that's doing this for you and that you're giving the money to. All right. There are some risks and potential pitfalls, because, as we said, there are some requirements, there are some compliance issues. So if they are not in compliance, there will be problems. So, of course, if the structure resembled the abusive easement, the IRS would not allow that or would challenge it. The appraisal challenges. So the IRS wouldn't just take the appraisal value and call it and will depend on it. They may challenge the value. And I have to say that this is a highly audited investment because of the tax savings related to it. And in some cases, it takes 7, 10 years in order for the IRS to like, because they go through like appeals and courts and stuff like that. And usually with these partnerships, they put money on the side to pay for any legal fees related to that. They insure your investment amount. So in case the IRS like voids the transaction or whatever, they challenge the fair market value and they want to just say, okay, we're canceling it. They give you your money back. You give you the investment amount that you invested back. However, you have to pay back the savings. So it's like you're canceling the transaction as if it never happened. So that's the risk that's related to it, and you have to be aware of it. And if you want to proceed with something like that, um, and again, you have to have a conversation with the partnership because they're familiar with this risk. It's not something that they're not aware of. It's something that they do all the time. And as I said, that's why they insure the money that you put in, the investment amount. They put money on the side, reserve it for any legal costs related to IRS suit cases and court cases. And it takes sometimes 7 to 10 years to get to either okay, approved, nothing happens, or worst case scenario, it is void and you have to pay back the savings that you saved today in 10 years, but you made use of the money, all these savings you circulated in other investments, you made 10 times or maybe in other cases more if you do it smart. You this X amount that you saved today, you circulated in other investments and you got your return on investment 5, 10, 100 times more that you don't care even if they come at the end of 10 years and they cancel the transaction. All right. So again, there has to be some documentation that's properly kept, like the qualified appraisal. In some cases, you pay for like you have to sign or fill out Form 82, 83, signed by the appraiser and the charity. But in other cases, you just get the key one and you report it on your 1040. There has to be written acknowledgement from the charity. Most of the time, you don't have to worry about this as an investor. The partnership does that. Same thing with the audit, by the way. It's mainly on the partnership level. You as an individual, you don't get audited. Deed of transfer, that it was transferred, so you're not keeping or you're not retaining the rights on the land, supporting valuation and legal documents because you have to support your position why you're valuing this as 4 times the original amount. So who should consider this strategy? Number one are high income taxpayers seeking significant tax relief, especially if it's at the year end like now and you don't, it's like 1 to 3, like you don't have to do much in order to get this savings. It's very easy, very, doesn't require much effort from your end, and it's very quick too. So and if you have a high tax bill expected, this may be very significant for you. If you're an investor that you seek blended tax and investment outcome, this could be for you. If you are a donor, in like normally you donate to charities, normally you're have that on your tax returns. So and you're also interested sometimes in land conservation, then this is for you. So just to summarize, the fee simple land donation, it provides immediate tax savings, it provides potential long-term economic benefit, and it gives you strong compliance framework when structured properly. So if you have any questions about this, if you're not sure if this fits your plan or if this fits your portfolio, if it would bring you savings, or if you're at this level of AGI that you could benefit from this, please reach out and we can talk more about it and see if it's worth the risk or really or not really. All right. Thank you so much and talk to you next week. Bye-bye.